Welcome to the ARMR Report. This is a pop-up, impromptu, during the trading desk and trading action moment for all of us. We've been chatting a lot in the Slack, real-time trading room for all ARMR insiders. And there's just a lot to cover today, and instead of typing it all out, I thought I would share it with insiders and share it with all YouTube subscribers. So again, this is the ARMR Report. It stands for Algorithmic Risk Management Research if you're new. That means everything we do here begins and ends with managing risk, and so there's a lot to talk about today in that regard. This is a show about quantamental investing. It's a combination of quantitative execution using computer algorithms to tell us when to add or subtract capital from positions, and combine that with a fundamental foundation, and that's the information edge that I share with you every time I do this. So bear with me. I'm out of the office right now, so this is sitting on a couch in my room. All right, so I'm going to share with you, but we might be interrupted from time to time by children running through the house. All right, here's the situation. I'm going to share with you information directly off the trading desk that I'm using to manage my own capital and then capital that I manage through our interactive brokers relationship. This is not a show to tell you run out and buy something. I don't know you. I couldn't possibly give you advice about what to put in your portfolio, right? We'd have to sit down and talk. Any ARMR insider who would like to, pick up this conversation after the video, certainly give me a call and ask me questions, and I'll share with you some deeper thoughts about how it could work personally in an account. But for this conversation, do your own work, right? I'm just sharing with you my thoughts of how we manage capital. So let's go. Number one, we are adding to the top of our whiteboard a new sector or a new group. So those of you following along recently know that we're basically focused right now on three groups. We're focused on precious metals, which I'm going to get to a little bit later in the show. Okay? We're focused on disruptive growth. I don't call it stay-at-home stocks. I call it disruptive growth. These stocks are going to do well even when people go back to work, but their businesses have accelerated because of the virus. Okay? And the third group is cannabis. Always loved cannabis, and we've been adding cannabis, and you all know this, over the last couple of weeks, maybe really last week. Okay? So those are our three. Today, we have a definite algorithmic entry point. So an algorithm that we use that's designed to help us find entry points into group ETFs. It does not mean we're buying the ETF. It just tells us this is where money's going. This is a good risk-reward opportunity. The algorithms that we use at the ARMR Report are designed to give us the best probabilities of success. They're not guarantees of success. It's not a crystal ball. It's not a neural network that's, combing, news stories and putting trades on. It's literally looking at reward versus risk, potential upside versus where the stop would be, and crunching numbers to figure out, is the probability high enough that we can make money on this as an investment, not necessarily a day trade. It was certainly not a day trade. Not necessarily a swing trade, but you can swing trade it, right? I'm not telling you how to invest. I don't know what you like, okay? So what we do here is we run these algos on different groups that we're monitoring. And when we get a risk on entry point there, we usually dive into the ETF and look at the best companies and pull out which companies we think are driving the move. We don't necessarily want to own the whole ETF. So this is the group that is forcing us to raise these names to the top of our whiteboard, and it's new, and that's why I decided to do the show right now for all of you. Without a doubt, the last 2 days, we have seen the dividend-paying group rise. And so specifically today, we see a risk-on entry point in the utility sector. XLU. Now, insiders, you guys know we have 3 portfolios set up: conservative, balanced, and aggressive portfolios. Okay? Up until now, we own the same 3 groups in all of those portfolios, but position sizes are different, right? Okay, more aggressive, obviously bigger positions. What I think I'm going to want to do, and I haven't done it yet, but I think I'm going to want to shift some capital in my conservative ARMR portfolio into not necessarily utilities, but if utilities look this optimal, so that the reward is worth the risk here, and the probabilities are right, it behooves us to put some of those type of stocks into conservative accounts. So what we'll probably do is we'll find some room for the conservative portfolios at the end of today. Whether we book profits on some of our disruptive growth, whether we do it on precious metals, probably not. But we'll have to look. We'll have to find out where the cash is. We have some cash on hand, so we might just use that cash. And so what I'm going to share with you, just two ideas off the top of my head. Not for you to run out and buy. Please do your own homework. Do I have to keep saying that, or are we all on the same page here? We're all grown-ups. So when I look at XLU, and we could take a quick look at it together. Okay, that's XLU. Okay, so what we're seeing here is a double bottom and a risk-on entry point here in the utilities. And so what I look for are the best names in the space with a higher yield. So XLU has a yield of 3-point-something%. I like Duke, DUK, a yield of 4.5%. Dominion, yield of 4.5%. Actually, Dominion looks even better. The stock's trading above the moving averages. Coming right out of a pennant, for those of you who are chart enthusiasts. Okay? And what does this really mean? Why are we getting that type of move on utilities? That's a real good question. This is not a sexy story, guys. Okay? This is not sexy. This isn't cannabis. It's not precious metals. This is the most boring sector of the market. Okay? But for conservative accounts looking for yield, it's not boring at all. 4.5% in a utility, and adding that to a portfolio to reduce the volatility of a portfolio is called risk management. It's not for everybody, but you know if it's right for you. Okay? It's a way to manage risk. If the wild swings you're seeing in the market are making you a little nauseous, but you still want to put capital to work because we're in a mechanical bull market, then you look at utilities and you say, hey, here's a group where the mechanical bull, the mechanics, Fed Chair Powell, central banks around the world, driving rates to negative interest rates. What does that really do to the capital structure? People who own government bonds and just collect the yield there can't do that anymore, right? And it becomes more and more and more of a problem. So it forces everybody up the food chain to more and more and more risky assets, right? So if you look at it, utilities are more risky than government bonds, right? Unless they're Greek bonds from 2008, but you know what I'm saying. Okay? So up the capital structure. So it makes sense that utilities are starting to look better. It kind of doesn't make any sense that they got destroyed in the bear, what do we want to call it, a crash. They got wrecked under the ridiculous theory that people aren't going to be paying their utility bills and they won't be able to pay their dividends. All right, because, okay, now we know none of that's true. Okay, so they're going to pay their dividends and people are paying their bills and the economy's reopening. So instead of buying an airline or a cruise company or any of those types of names, which you can do for a trade if you want. I don't have any interest in owning airlines, even in a great market. But a portion of capital in utilities at a 4.5% yield that lowers the risk in my portfolio for the right account, that's a no-brainer. Okay? So when I think utility, it drives me over to thinking about telco, right? AT&T, Verizon, CenturyLink. These are companies, look at AT&T. Huge amounts of debt, everybody was worried the company won't be able to pay its dividend, won't be able to service its debt. That's why the stock was down. Let's take a look at the chart. Okay, so you're looking at AT&T, long-term double bottom. I mean, look at it down here. Last year, this was an ARMR portfolio addition, right at the same price level we're at now. We had a great run. We picked up a bunch of dividends. We got stopped out on the breakdown. Okay, now it's setting up again, a double bottom, and actually it gapped up 2 days in a row. Okay, who knows? You might be able to find a better entry point. I'm not saying to run out and buy it today. I'm saying these names are at the top of the whiteboard now. That's a 5+% yield, 5.5 maybe. There's Verizon. There's Verizon. I love it. You got an Andrews fork set up on Verizon. You can see the Andrews fork, it's called. Right at the bottom of that chain, right? And the expectation is to move back up to the top, which is the channel it's been trading in, you know, going back to 2017. You're buying a double bottom right on the low. 4.5% yield. And then, you know, for something a lot riskier is CenturyLink. Okay, people are concerned that they're not going to be able to pay off their debt, but they're in the process of, this is the fun thing. Here, let's get back to this conversation for a minute. AT&T, CenturyLink, these guys have a lot of debt in the balance sheet. It's a risk. If the world's imploding and no one's paying bills, it's a huge risk. That's why the stocks got destroyed. If the economy's reopening and everyone's starting to realize the world's not coming to an end, even if there is another flare-up, these companies aren't going out of business. And in this mechanical bull market, rates are being driven down to negative interest rates. So it makes it easier and easier for a company to refinance the debt on their balance sheet, which frees up free cash flow. And they can service their dividend. Okay? This is for you, Chris. All right? CenturyLink at a 9.5% yield pays a dividend at the end of the month, and you can write calls on it and collect even more of a yield. Okay? So those are some of the thoughts that I'm thinking about on my trading desk for my portfolio. Not telling you go out and do it. You have to think about whether or not that works for you. Okay? So that's the new sector that we're looking at, and I think we're going to shift some capital in our conservative, maybe even our balanced portfolios to get some of these plays in there. All right? Lock in a solid yield, collect that dividend over time, and reduce the volatility in the portfolio. Okay? Let's move on. I wanted to talk to you about gold and silver. Take a look at this. That is, of course, the ARMR Report. You guys are getting a free look into the top of the whiteboard. This is just our whiteboard of our favorite names. We have it listed here, and we update them, you know, over time, every day. Okay, look here. Okay, I'm looking at right now showing you real-time futures prices. You can see right up top here, gold is trading at 1711 for the June contract, 1712 for spot. Earlier this morning, both of these were below 1700, and there was a $10 to $11 backwardation spread. Futures were $10 or $11 cheaper than spot, and this created, and this has been true for the last couple days, this was created because today's the first day of Comex. It's the Comex OPEX day, options expiration. The Bank International Settlements, BIS OPEX, is Friday. And this is always the time of the month that gold prices suffer. Because as you roll out of one, which is the June contract, into the August contract, it creates a capping effect on the price. And so if stocks like GDX, GDXJ are in the stratosphere after a huge run, it's just an excuse for the algos to sell them. That's what's been happening for the last 48 hours. This action now that's brought that backwardation spread only to $1 makes me feel like, and I could be wrong, it could be hit again, but it looks like the Comex OPEX is over, and it looks like that those shenanigans are over. And this is why the stocks are rallying off the lows today. And we'll have to see where they are at the end of the day. I mean, I know Newmont, what was down 5% at one point, now it's down 2.5%. I know, I'm not going to go through the list of them, but they were all a lot lower this morning, and they're all rallying in the afternoon. So 2 down days is something you have to suffer through, and that's just the way life is. 3 down days is an issue. So by the 3rd day, I need to see some snapback, and we're getting that in metals, which they're all up across the board, including silver now. Okay, so just wanted to come on here and share with you guys. It's just totally normal action at the end of the month. It creates some craziness. You have to manage your stops correctly because you don't want to get stopped out in the morning during a period of time where you know they're gaming the system. There's gaming trades going on. There's capping going on. There's rolls going on, all that kind of stuff. And guess what? There's algos that are written to stop hunt and try to take you out in the morning. Okay? So we try to avoid that. Now, if we have to adjust at the end of the day, we will. Okay? We're going to adjust if we have to. But you don't want to get, scooped on your positions in the first 2 hours of trading. All right. I think it's a live trading desk, so I'm just taking a look at a couple of
Monday.com is the project manager.
Just want to make sure I've covered everything I want to talk to you guys about. Oh yeah. One last thing. Gosh, how could I even forget? Okay. Want to share with you a new cannabis company giving us an entry point today. Now, I've talked to you guys about the stock before, so you all know it if you've been watching me. January 1 of this year, did an entire video on how I believe Innovative Properties is going to be the best cannabis stock of the year. Okay? And in January, right through the first half of February, the stock was up 38%, outperforming every major cannabis company for the year. Then, of course, stock sold off, the market crashed. So we were waiting for this company to announce a secondary. That's not the stock I want to show you. Here we go. All right. We were waiting for the company to announce a secondary. We knew they wanted to raise more capital. The way this works is they raise capital, they put the capital out pretty quickly, they get to increase the dividend. So there's a graphic representation of the chart. You can see here the date that we added it. Stock ran up 37% in 8 weeks. We ended up getting out of the stock as it broke down below its stop. Okay? Now, I'm not sure this is going to be the #1 pot stock of the year anymore. I just said at the start of the year, it certainly has outperformed every other cannabis company out there, the big ones. The big ones. I know some of you out there are thinking about PW. That's a small company. It's a small company. I wish you the best of luck making money there, but that's not a place for me. I need something that has liquidity, and I can trust the trading is not being gamed by one individual. Okay? So, stock breaks out above the 200-day moving average. They did the secondary today. They priced it, raised $100 million. I think the price they did it at was somewhere in the 74, 75 range, I think. The stock is trading at 84. It was 85 yesterday. So it's another example. Most of the time when a company does a secondary, the stock drops the amount of the dilution. So it should have dropped to around $77 today, based on the amount of shares that they brought out, based on the amount of shares that are already outstanding. Okay? It should have traded down to 77. It didn't. It got as low as 81 and change, which we were buying it in the aftermarket last night at 81.5. Maybe it dipped a little bit lower today. I don't exactly remember. And so now it is trading at 84. Look, this is not a day trade. This is an investment here. Okay, there's 2 things I want to share with you about the deal. Number one, I speak to management regularly. They have more opportunities in their pipeline than they can handle. So the question was, when will the investment banking business open up and allow them to raise capital again? Because during the collapse of the virus, nobody wanted to do anything and you couldn't raise capital. management thought they'd be able to get that window open sometime in late June, early July. The fact that they just did it in late May is very bullish about the market. Forget about just the stock. It tells you that the market is coming back. Institutions are willing to take risk again. That's key. It's another piece to the puzzle of this mechanical bull market that I'm talking about. Okay? And so, one of the reasons the stock was down, this stock does well when they raise capital, and you can see as an institutional investor that they're going to be able to raise the dividend over time. That's what makes it bullish. Okay, so when they can't raise capital because of the virus collapse, puts the stock on hold. Now that they're able to raise capital again, you could start looking out ahead and saying, okay, the dividend should be able to increase over the next 6 to 12 months, and this looks like a quality idea. And so that's why it's back on our radar, and that's why we like the stock again. The deal's out of the way. We don't have to worry about any weakness from a deal announcement. And again, the stock is acting much better. I mean, I was hoping the stock would trade down at 77, and it still may. It still may. It could make it down there tomorrow for all I know. Anyway, I just wanted to remind you guys, you've asked me this in the past, what I think about innovative properties, because you know we were on it early in the year. And I kept saying to you, I'm waiting for the deal to come out, and that's when I'll be more interested in the stock. So here it is. The deal was done last night, and I'm more interested. All right, those are my thoughts for right now. I got to get back to the trading desk. Let me just take a couple questions if there's anything out there. A few questions for you. Yeah, IIPR, it is dilutive, right? Because they're bringing new shares out, Chad. So it is dilutive, and it's dilutive to the point where the stock should have been trading at 77. But the beauty of this stock is it's like a bought deal. In other words, they don't have to go out on a road show and explain to anybody the benefits of their business. They go to a couple institutions. They say, look at look at everybody in our pipeline that needs cash, and the institution says, okay, here's the cash. Let's do business. And the stock holds up. Again, it might sell off into the close. So this is not a day trade. I'm talking about an investment and collecting yield. And it goes right alongside the idea that the dividend stocks, all the dividend stocks I follow, I have many different, radar screens, if you will. One of them's only dividend stocks. And yesterday, every single stock was up. I mean, like every one. Utilities, telcos, everything. And this stock pays a fat dividend as well. So it was dilutive, but that's not a problem. DraftKings, yeah, I mean, DraftKings, what am I going to do? The stock's gone through the roof, and I'm certainly not going to chase it here, but it's on my list to watch for the next consolidation point. And I wouldn't trade the warrants. That takes a lot of extra risk, right? So this is about risk management. You could trade warrants if you feel your risk level is acceptable, okay? But, that's up to you. All right, guys. Any other questions before I sign off? Anything at all? I'll give you a couple minutes to fill up the board. And then I'll split. No? All right, great. I will talk to you guys again on Saturday, 11:30 as usual. I hope you enjoyed this little quick look in to the trading desk today on the ARMR Report. Take care, guys.